Hello, everyone, and welcome to the Build Better Homes podcast. I'm your host, Royal Mortier, the owner and founder of PLIRIS and its subsidiaries, and our mission here is to bring you information to help you build better homes, invest better, finance better, and just overall build the life that you want through real estate. And today I'm blessed to have a gentleman that I've actually listened to on multiple podcast interviews. I've talked to him personally about deals, and his team has helped me explore and calculate out deals that some worked and some didn't. And he's just been a wealth of knowledge, and knowledge that he frankly shares vastly and for free, and has an amazing team, highly informative and very educational. Again, I'm blessed to have the great Jeff Chisum of North Point. A little bit about Jeff. He's been married to his wife, Valerie. He dates wonderful wife, Valerie. I'll emphasize that. For 28 years. He's father of 4, and one of his sons, I'll emphasize, trains jujitsu and is a phenomenal athlete. So myself as a jujitsu practitioner, I'll enjoy him. He owns multiple STRs, short-term rentals, mainly in the Arkansas area. He's a 16-year veteran of the mortgage business, and he has been in the top 1% of mortgage brokers since 2018, which is an amazing feat to be at such a high level for so long in such a competitive industry. So that's really awesome to see. He is an STR finance specialist, and his specialty is multiple different types of finance avenues for short-term rental investment, leveraging your primary residence, and growth of your rental portfolio. And we'll expand on that more in today's interview. But Jeff, thank you for joining us.
Yeah, well, I appreciate the introduction. It's an honor to be on, and look forward to hopefully adding some value to what people are doing in your audience. So always am up for the opportunity to educate and empower people. So yeah, I look forward to it.
Fantastic. Well, I guess I always kind of like to start off with knowing a little bit of the backstory. So where did Jeff grow up, come up from, and how did he wind up in the mortgage industry?
Yeah, absolutely. So grew up in Round Rock, Texas. It's Central Texas, right outside of Austin. A very just kind of normal childhood where everything that I could ever need was provided, not given everything that I wanted, which was very healthy upbringing. Kind of grew up as the underdog. So I was always the smallest kid, was always the kid that got picked last. When I graduated high school, I'd played varsity football all the way up to my senior year. And I think when I graduated, I was like 5'8", 155 pounds. So, playing Texas high school football at that size, if you've ever seen the movie Rudy, where he is vastly undersized, but he didn't let that get in the way. That kind of describes me, kind of the overcomer, chip on my shoulder, have something to prove to other people. So that's really carried me through my professional career, where I always felt like I could do better or be better, and in turn get better. So being in mortgage and really my whole adult life being kind of in a commission-based position, that has really lent well to just kind of that mindset of the harder I work, the more I can go out there and achieve and do. And so, yeah, it has been quite the journey to get into the mortgage business back in 2008, which I'm sure everyone knows what that looks like. But just in case if you're under a rock or you've got short-term memory issues, that was the year of the crash. And that's when I got in the mortgage business, and I kind of fell into it, where I was at a Bible study one night. I had been laid off from another position. A guy said, "Hey, you ever think about originating mortgages?" I'm like, not really. I have one. So, I've purchased a home, but don't really have any knowledge. And really what that did for me, my first position was city mortgage in a call center, consumer direct. And so I was able to go through world-class training. They were at the forefront of all of the regulations that were coming into play in the mortgage business, because before then it was really kind of the wild west, which kind of led to what we experienced in 2008 and 2009 2010 with the mortgage crash. But I could raise my hand. I could, if I had a question, I had an issue, I had 150 people in the room that could answer that question for me. So look back on it, 4.5 years in a call center was not the best experience from the standpoint of just sitting there all day on the phone. But from a developmental standpoint, I couldn't have asked for a better situation and path. So kind of led to a point where eventually went out on my own because, big banks do banking really well for the most part, but mortgages can be a different animal. And if that's not your concentration, it can be hard to operate in that world. So I told my wife at one point, hey, if I'm going to be serious about this as a career, I really need to go out on my own in the sense of self-sourcing my own business. Yeah, we made that move, went with the independent mortgage bank, independent mortgage company, started self-sourcing my own business. And that's really where I learned to hustle, get out there and really educate people on what opportunities were out there. And that really set the course of really how I do things today, which is, you go out and serve other people and find solutions and be able to present things that they don't know about. You're always going to have a place in this world. So that's really what we found in the short-term rental space, which today we've really evolved to where that's 100% of our business. And where I found myself in the short-term rental world was buying my own property initially. So before that, probably 6 or 7 years ago, I came across some information with the Fannie Mae second home occupancy loan. I felt like it was significant information and a change in that product, put it in my back pocket, and lo and behold, 4 or 5 years later, I was finding myself in a position where I was using that information to take advantage of the product, the second home occupancy product, and buy my own property. So what kind of led to that point was we had been looking at how we wanted to be good stewards of the things we had been blessed with, and looked at the stock market, look at buying long-term rentals, and there really wasn't anything too exciting there. And then we had been staying in short-term rentals when we vacationed because we had a larger family. It just made sense versus hotels. And so we had been staying in short-term rentals and ended up staying in a property in Arkansas. My son had gone out there and got on with the fire department. We were looking for a place during Christmas to stay. Found this beautiful lake, beautiful property. We were paying a significant amount on a nightly basis to stay there. And my wife and I were like, this is where we need to invest. We need to buy our own short-term rental. We need to, have a place like this. So we ended up buying one. And again, back to just my knowledge of the product, put us in a position because of that knowledge to only have to put down 10%. Back then, we caught the interest rates when they were crazy low. So I will probably have that loan for a long, long time because it's at 2 5/8%.
As essentially a second home investment property, you got it at 2 5/8 with 10% down.
That is exactly right. Yeah. Yeah. Those days are behind us. We probably will not ever see that again. And I mean, hopefully not. That means something probably pretty bad has happened with the economy or the United States, but we did take advantage of it. So maybe right time at the right place kind of thing. But yeah, 2 5/8. And then when we were looking at that property that we ended up purchasing, we had toured another property. And that was the very first one that we looked at because it was kind of this quintessential cabin in the woods. So when you look at the listing photograph, it was like the music comes on, the lights come on. It was kind of that idea of what I wanted. Well, we got out there and it was in the middle of a golf course, which it was absolutely beautiful. So this area where we now have both of these properties, Ozarks, it's a Corps of Engineers lake. So nice change in terrain. It's just absolutely beautiful. But this golf course cabin, we went out and looked at it. It was in between 2 golf courses. The house itself was great. It could hold a lot of people, big spaces, had a game room, pool table, just a perfect property to set up a short-term rental. And it had a 10-year history as a short-term rental. So they knew what they had. They were operating well with it. But when we arrived, there was a group of guys there and we were like, wait, we had scheduled a showing. They've got a group there staying in the property. And these guys were nice enough to let us in the house and take a tour of it. And they've got their beers sitting everywhere and their little Debbie cakes. It's just a guy's trip, guy's golf trip. So we got to actually see it operating as a short-term rental. And we walked outside, almost get hit by a golf ball. And we were like, this is not what we were looking for when we were talking about a vacation home that we would also rent out as a short-term rental. So went on, toured some other properties, found the lake house. So the first one we bought, lake house, lakefront, 2 boat slips. It is absolutely beautiful. But a few months went by and I had a bunch of 401k money sitting around with different past employers that I'd worked for, and I had consolidated them into a self-directed IRA. So they were really sitting there doing nothing other than I had this idea that I was going to take that money out of the stock market and deploy it in places that I chose to deploy it. So long story short, end up coming back around and reached out to the seller to find out if it was still for sale. And they had actually taken it off the market because it was just too hard to show because they had too many bookings. And I was like, that's exactly what I want in a full-time investment property, short-term rentals. Your problem is you can't sell it because it's too booked. You know, my wife hesitated a little bit about that idea, taking that 401k money to buy the property, but in kind of perfect timing, had a date night the night before all the GameStop and Reddit stuff happened. And we had discussed buying the property. The next day, all that stuff happened. And I told my wife, that's all the market manipulation and games that I was talking about last night that happened in the stock market. And she said, I see what you're talking about now. Let's just go for it. So that's how we ended up buying the second one, was with a self-directed IRA and a non-recourse loan. So that's another thing that not a lot of people know about, is how you can use that self-directed IRA to buy real estate. But that's how I did it. So always happy to talk to people about that. But not my niche. I don't even do that loan. That loan was done somewhere else. But yeah, we found significant opportunity in educating people initially about that 10% down second home occupancy loan. And there were so many times where I had people tell me, Jeff, I wish I would have caught you a couple of years ago because I put 20% down in that same scenario. And it was a common conversation that I was having with people in that scenario where they were going to their mortgage guy and saying, hey, we want to go buy a place in Florida. You know, we want to rent it out on a short-term basis. We want to go buy an investment property. The loan officer never asked the question, well, I see that you guys live in Chicago. Florida is a common vacation area. Do you guys plan on staying in that property from time to time? And if they would have asked that question instead of getting locked in on, hey, I'm going to go buy an investment property, that's the difference maker between taking someone down the route of the 10% down loan versus the 20% down investment property. So just to this day, I'm constantly having conversations with people that they just don't know about the opportunity. And before you and I got on the recording here, we talked about that DSCR loan that not a lot of people know about as well. So definitely want to get into that. But yeah, that's kind of my intro, my story. And the thing that I like to share about that journey that we went through as far as investing and where we end up going, the road we ended up going down, is with vacation rentals, your kids, and I have 4 kids, as you mentioned, all the way from 24, 21, 15, and 11. You know, they weren't going to get real excited about dad, the landlord, and going in and seeing the rent house. We weren't going to have great conversations about what's going on in the stock market. They get excited about going to the lake house, and they've seen the sweat equity that we put in to get that property a place where it's going to perform well, and what goes into that. You know, it's not you just throw it up on Airbnb and, you know, make sure that you have some supplies in the kitchen. You know, it goes into the hospitality space of being hospitable, which we certainly believe, you know, we're called to be hospitable. And so we've been able to just model to them what it looks like to take action to achieve levels of success and what goes into that. So I'm a big believer that it's more caught than taught. And this has been a great example of them being able to catch lessons instead of preaching out them, hoping they'll get the right message, if that makes sense.
Oh, absolutely. You covered a lot. I was keeping mental notes here and I'll kind of chop it up. So the first one that I want to hit on though is, and I love what you did here, is that with the lessons with the children, and you maybe have seen this in the mortgage industry, I've seen it in the real estate investing side of a parent passes away and their kids inherit a significant amount of real estate. And the kids want nothing to do with it because that wasn't cash flow to them. That wasn't an experience to them. That was, Dad's not at my baseball game because he's fixing a toilet at the rental. Dad's not able to hang out this weekend because he's got to go take care of landscaping or repaint the rental while the tenants are out. They don't care about the money. They don't care about the asset. All they look at it as, I lost the time with my parent because they were focused on this investment, not on the time with me. And, that's an important thing for a lot of us to think about, especially when we're making our investments of how much time is this going to take away from my kids? And I have a business mantra that I use, a business decision-making mantra that I use, and it's called profits. And it actually has nothing to do with money. But the P in profit stands for pain. And pain is our 24 hours in the day. And putting that to what we actually want to be putting it towards. So, so many people, they pile things on with extra rentals and extra investment properties and extra business ventures and not looking at the pain that they've taken away from their day. Because you're saying yes to this, you're saying no to something else. And the last thing we want to be saying no to is our children. We want to have as much time with them as possible. So the fact that you've created a cash flowing asset, a great asset, like you said, caught, not taught, is showing them like you guys can have assets and investments that aren't taking your time away from everything. Okay, maybe we go here and we go on vacation for a week. And during that week, we got to paint a room or fix up, go pick out some furniture or fix some things up. But we're here on vacation enjoying ourselves as a family. We're just doing a little bit of work while we're at it. And this is something we're going to own forever. So when I pass away, guess what? You're going to be bringing your kids here. My grandpa, he had a coast house. He's since passed away. Guess what? Anytime any family comes into town, where do they want to go? The coast house.
Yeah, that's awesome. Well, in our real estate investment company is called Build Legacy, and it's right in line with that, where your legacy shouldn't be something that you just leave behind. It's something that you intentionally build, and you've got to have that vision for what the end looks like. And the people around you that you love, you want to make sure that what you build didn't destroy what you have with them. That's such a great point.
Especially in today's society with remote work. I mean, it really has opened up a whole nother avenue, a whole nother level where we're not bound by the commute to the office, work our 8 to 9 hours, commute home, maybe see our kids, maybe catch a game, maybe see our kids for dinner. We've been able to chisel away at that. And I'm a huge, huge proponent of the remote work environment at all levels. But the other part of that is definitely the investing correctly. Don't just invest just because, hey, it could make me some money. Invest for a lifestyle. Make those business choices for the lifestyle that you want. I've seen both sides of it, of people that invested for, like you said, building a legacy. And I've seen the people that were like, well, I had this opportunity to buy into this or invest in that. And so I did it. And now it's taking all this time that I didn't expect because they didn't analyze the deal right. They saw the dollar figure. They didn't see the time, the risk. It's exceeding their fear level. It's taking the time that they have to be in the deal is way longer than they anticipated. The more horrible case is they made the investment and their spouse wasn't 100% on board. It turned sideways and then their marriage goes sideways.
Right.
So that's terrible to see. So I love what you're building there, and that's great. And you get to go see your son that is the firefighter up there, go have a nice vacation. And like you said, it's always nice when the seller's like, I can't sell it because I can't get showings because it's booked all the time. All that.
Right.
That's the exact business you want. So let's dive into the loan types. We'll touch on one. I know a little bit about it, setting my kids up to be able to use this type of loan, which is an IRA. I'm not a wealth advisor. I'm not a financial advisor, but I know the general structure of it. But essentially, I can use assets within an IRA, set up a separate LLC that buys the property, and essentially the IRA is funding the payment, the down payment for the property through that LLC. But now those things are merged together. And so now that property you purchased using the IRA is not a stock asset, but a physical real estate asset that is now owned by the IRA. That kind of break it down into.
And that's definitely not my expertise, even though I have personal example of using that. But a lot of people, what I will say about that opportunity is you can pair that money with a non-recourse loan for acquisition. So in our case, 50% of the acquisition came from the self-direct IRA. The other 50% came from a non-recourse loan. So a non-recourse loan, for people that don't know, because we'll talk about the DSCR loan here in a second, which typically require a personal guarantor. The IRS says that you personally can't be responsible for the loan. It's the IRA that is responsible for the repayment. So the other 50% came from that non-recourse loan. So there are loan opportunities that you can pair with that self-direct IRA, which is a great option. It just increases your buying power and go out there and basically double the asset with that loan. So it's been a good option.
Yeah, as I expressed, I'm setting my children up with essentially their own IRAs, which they do make IRAs for minors that then can be rolled over to adult, but you can do the same thing with them and in using it as a leverage. And as we're continuing to see real estate values rise significantly, inflation pushing that, regulation pushing that. I mean, 3 years ago, we were at a $6.5 million deficit of the amount of single family dwellings we needed, and it's only increased. So where there's always going to be that massive demand. So using that compounding interest of an IRA at your child's level really sets them up well with minimal monthly investment. And how I'm doing it is they have that. When they're a teenager, we're going to use that to leverage a piece of real estate, preferably in a city that is where they want to go to college at. And then now they have a asset in the city where they want to go to college. And now when they go to college, they can either live there and rent out the extra rooms or just constantly have it as a cash flowing asset while they're going to college. And then they can use that to pay for their own school. Gives them more freedom than, say, a 529 plan, gives them a physical, tangible asset to have, and teaches them a lot of life lessons. That was my goal in setting that up.
Yeah, they get to carry the asset into their adulthood. So yeah. That's smart.
Yeah. So let's hit on this 10% loan. I have a men's group I was a part of. A lot of them were STR investors. And I mentioned to you offline, I'm on the Emerald Coast in the Gulf Shores to Panama City. And in our area, at least a couple of years ago, it was 5 of the top 10 cities were along the Emerald Coast for STRs. And now it's still a massive demand, but that was during COVID. Florida was open. Alabama was open. Now, post all of that, obviously the demand has dropped significantly for coming along the Emerald Coast. So we saw a massive dip in the actual numbers. We're seeing those slowly start to creep back up. But as you mentioned, you have some places, kind of central Arkansas, not places many people would think of having an STR. And what I find interesting is the guys that I've talked to that have some of the best performing STRs, they're just outside of major metropolises. So they're like a 30-minute drive outside of Atlanta, and all their renters are all people just wanting to get out of Atlanta for the weekend. They're near Birmingham. They're near Houston, kind of just outside the big cities. So where I'm at, everything's dense. The reason that STRs are in high demand is there's almost no more land to build hotels on, or the jurisdictions aren't approving any more hotels, especially waterfront hotels. So that's really pushed the STR demand. You're exposed to this all over the U.S. What are you seeing as where places that are really performing well, or why maybe certain things are performing over others?
I try to stay in my lane as much as I possibly can. So that's financing. But what I do tell people is find, like you said, a lake or find a view that they can't get in the city. So close in proximity within 3 hours of a major metropolis type area, and then find an area that is going to support year-round activities. That's why I like places like Arkansas, Alabama, Tennessee, pretty much where the weather is going to be, for the most part, fairly mild all throughout the year. Let's take Arkansas, for example. Does it get hot? Yeah, it'll get in the summer, mid 90s, high 90s, but it's appropriately hot. It's the summer and it's on a lake. Corps of Engineers Lake, which is absolutely beautiful. So when we're in the boat, someone's down in the water, you can see their feet. The water's so clear. But people want it to be hot outside when they're out on the water on the lake. So it's appropriate. And then the fall is nice. You've got the foliage for people to come out and enjoy. But that's when the off-roading trails start to heat up. So Arkansas has tons of hike and bike trails, tons of off-road vehicle trails. And when it starts to get cooler, that's when people want to ride. And then it kind of slows down in November, December, January, but you still get those holiday weekends. You still get some weekend guys trips, girl trips. We have a lot of golf in Arkansas. So again, once it's cooled down, you get more golfers out. So that's even in February, March, April. So you just want to find a place that has as close to 4 seasons as possible. You don't have to be in the Smokies. You don't have to be in Florida to have a high producing short-term rental. You just have to be in a place that's going to support activities so that when people want to get out of town, they can go and drive a relatively close distance from where they live and get there. So like for the Dallas-Fort Worth area, it's been Broken Bow, New Mexico. But I tell people, pick a lake, find a lake. People love to go to the lake, buy a place on the lake. What's funny is we were never lake people before we bought our property. And now we've got the Tri-Tune 150 horsepower boat. We've got an off-road vehicle, which I never grew up with motorcycles or go-karts or anything like that. And now that we're doing it, I'm like, I see what the big deal is about. We have a lot of fun doing all these activities. So as soon as we get out there, it's what took us so long to get back out. And when we leave, we don't want to leave. And kind of same thing I tell people all the time, pick a place that your family likes to go where there's activities that you like to do. And I bet you're not the only family is going to be like that. So just pick a place like that your family likes to go. And I bet there's thousands of other families that like to do the same thing. So we've seen short-term rental stays slow down, but I don't think it's because of the popularity of short-term rentals or saturation of short-term rentals. I think more people are just keeping cash in their pocket these days because of the economy is just the general consumer, the average American. I think that is why we've seen a slowdown in short-term rental stays.
Gotcha. In our area, once everything really reopened, it was a pretty swift drop. And what I noticed is, because I've sought out quite a few of them, one of my neighbors, she works for a property management company that manages a lot of them, and the occupancy rates dropped just because so many other places opened up. And we're slowly starting to see those come back up. And there's still obviously the big popular weekends in our area that definitely drive a significant amount of people to the Emerald Coast. But a lot of what I was seeing shortly after COVID or within the year or two of it, was marketing based on COVID numbers, but they weren't getting anywhere near COVID numbers. Right. I think that's more particular to the states that just remained open, that were solid vacation spots, which the Florida, Alabama coast was huge for that. So,
yeah. And if any investor was basing their expectation on COVID numbers, that's pretty short-sighted. I think your savvy investor is going to realize that was an anomaly and look at more historical data. But yeah, there was plenty of people that got into the space thinking, it kind of reminded me of the gold rush. Everybody flocked to it because it seemed to be easy money, then found out it was a lot of work and things weren't as hot as they were. So yeah, I think a lot of people got caught into a trap there.
It's still something that a lot of people are reeling from. And now what we're seeing is, especially in the Florida area, is just a massive increase in insurance premiums for all real estate, not just STRs. And that obviously affects the bottom line, makes you have to raise costs, and then who's going to be the more competitive one. So you've got a lot of people that have owned their homes for a long time or are able to come in and buy cash, and then they self-insure. When you're spending $15,000 to $25,000 a year for insurance on a waterfront or near waterfront home, I mean, that's a big swing in your bottom line. So, and what your charge rate is to the end user. So anyways, you talked about staying in the lane. So let's stay in the lane of financing, because that's a big reason I brought you on here. So Let's touch on these DSCR loans. And there's two types of loans that I brought up to you beforehand, and we can touch on both of them here. And they're both loans that a lot of people are aware of, and they aren't aware of the acronym. They aren't aware of how they work. And so for the investment purposes on this one, the DSCR loan and the fact that you can do 10% down. And then the other one, which you can use obviously for your personal residence or investment properties, the first lien HELOC. So let's go ahead and I'll give the floor to you.
Yeah. So 100% of my business these days is financing for short-term rentals. About 90% of my clients are going to use the 10% down second home occupancy loan. So there's a ton of misinformation out there on that product. Highly recommend if you want to go through a short schooling on some of the finer points, just my efforts to educate people. I have a podcast on Apple and Spotify called STR Home Financing, where I touch on a lot of that information, but really that 10% down second home occupancy loan, there's no issue with you renting it out on a short-term basis. The bottom line is that first year, you can't put yourself in a position where contractually, because of a contract you've gotten into, you couldn't occupy the property when you wanted to. So you really just have to stay away from midterm rentals. So there's going to be a contract in place. If the tenant is going to be in there for 30 days or more, you want to stay away from that. You definitely want to stay away from a long-term tenant. Now, after the first year, you're released from that. So if you want to do midterm rentals, you want to do a long-term rental, you could. But yeah, so that is my most popular option because of the lower down payment requirement. People want to keep cash in their pocket for various reasons, whether they feel more comfortable going into the deal, that they have plenty of money to make the property rent ready and perform at the levels they expect it to, and give a good guest experience. So they don't feel like they have to hold back. For some people, it means they're able to go out and do another deal, which that's the other thing. People think they can only use that second home occupancy loan once. You could actually use it 10 times. You can have up to 10 mortgages in your name. There's nothing to say all 10 of those spaces aren't filled by second home occupancy loans. There's no distance requirements. You can have a property manager. It really needs to be a one-unit single-family home or townhome to be able to utilize that product. So those are some of the basics around that. It's going to also come with a typically lower interest rate than what you're going to find on investment property loans, a little bit higher than what you would get on a primary residence. So that's the big draw there. You can turn right around after closing and put title into an LLC without any threat, the due on sale clause being executed because of the change in ownership. So that's another thing that a lot of people don't know about that product. And then for the most part, what we originate outside of that second home occupancy loan is the DSCR loan, so debt service coverage ratio loan. So just to clarify there, down payment requirement is 20% for an experienced investor. So that's going to be someone who's owned a cash flow producing property for at least a year in the past year. We can do loans for new investors. It just requires 25% down. They will be required to be a personal guarantor. So that means they are signing documents that says if the loan goes into default, they're going to be held personally responsible for the repayment. If they aren't, the property is going to be foreclosed. That foreclosure is going to go in their name. So I bring that up because it's important to know, but also a lot of misinformation I've seen out there around the DSCR loan. I've done about 3 or 4 podcasts here recently because I've seen a lot of loan officers out there advertising this product and telling people that they do not report this on their personal credit. And also the idea is that that debt doesn't go against their personal debt to income ratio. Well, the only loan similar to that is that wouldn't go on your personal credit is going to be on that non-recourse loan. That loan where your credit's never pulled, you never signed documentation stating that you're personally responsible for the repayment of the loan, like every DSCR loan. So if you hear a lender that's doing a DSCR loan, they say it doesn't report to your personal credit, the next question should be, show me in writing. And I've called a lot of loan officers out here recently about that, and they've had to change their post or delete their comment because they cannot say that they put that in writing. And you and I both know if you don't put something in writing on a loan and it's just word of mouth based on what I tell you, that's not going to hold up. Because that loan could be sold. Their company can decide tomorrow that it's going to be reported. And the other thing that people don't realize is they think if that loan is going to be in the name of their LLC, they can hold title in their LLC, they're just the personal guarantor. They go out and try to apply for a conventional loan. They get to the declarations page where it asks questions like, are you currently involved in a lawsuit? Have you had a bankruptcy or foreclosure in the past 7 years? The other question is, are you obligated on any loan that's not reported on the credit report? Are you a personal guarantor, basically? You answer yes, you have to disclose that debt. It is going to go against your debt to income ratio. So that's been a big topic with me here lately about just making sure that I educate people on what it truly means to be a personal guarantor on a DSCR loan. So you are going to pull credit. There's minimum standards on credit score, typically 680. You've got to put 20 or 25% down. You have to have 6 months in reserves for the PITI payment just for that property that you're looking to purchase. And then the ratio, so debt service coverage ratio, DSCR, we're looking for potential gross income from the property to match the principal, interest, taxes, and insurance payment. So there are situations where you can get approval on negative cash flow. That typically is going to require a bigger down payment plus a higher interest rate typically, but you can go negative cash flow if it shows up front. Doesn't mean that you're going to buy the property and you expect it to negative cash flow. You're probably buying the property because you think it's underperforming, and you're going to, do the things that you need to have a property that's going to positive cash flow. 25% down, 6 months in reserve, 680 credit score, personal guarantor. We can do this on up to 4-unit properties. We can do it on non-warrantable condos. And typically what we're looking at is historical data from the seller. So if the seller is willing and able to provide financials for at least 12 months to show the cash flow of the property, we can get it from the appraisal. So a lot of times when we're doing short-term rentals in areas where short-term rentals are prevalent, the appraiser can get a hold of data that he can provide on the appraisal report to show the short-term rental income to prove the data. The nice thing about the product that we originate is we've been originating with the same investor for over 3 years now. We know what we can and can't do. So a lot of times we can advise up front whether it looks favorable before you even get under contract, whether we can get an approval. But our safety net is using air DNA data to show that the property is going to prove that 1-to-1 ratio. And typically when we're using short-term rental data, we blow that 1-to-1 ratio out of the water because that product was really originally designed for long-term rentals. So when we can show, short-term rental data, it's easy to prove that ratio. So the other thing to mention, because the next thing I was going to say, this is the easiest loan that we do in the space because we're dealing with short-term rental. From the borrower standpoint, you're not providing tax returns and business financials. It really is, we're pulling your credit. We want to see your bank statements, something to prove that you have that 12-month history as a landlord. Mm-hmm. And really from there, it's just finding the property that's going to cash flow for that 1-to-1 ratio.
So yeah, DSCR loans they're the quickest loan I've ever had process and the simplest loan I've ever had process. The 10% second home, that's another fantastic tool, especially if you're trying to jump in to something with, in many cases, a lot of these STRs, they were like a family's second home or third home, or that they maybe didn't rent out themselves and it needs some love. So to be able to go in there with a low down payment, do some work, get it spruced up, get it into a cash flowing asset, that's another great avenue. And then the last one that I'd love for you to touch on is the all-in-one, I've heard it called, or the first lien HELOC. Personally looking at this for my primary residence, I know I have friends and family that have done them and paid off their homes in 5 to 7 years and then use that to leverage and buy other properties. It's an amazing tool that not many people know about.
Yeah. And you and I were talking about that before we started recording, and I called it the biggest wealth building tool in the United States that Americans don't know about. And the reason for that is because banks don't win. Fannie Mae, Freddie Mac, I mean, they're the most successful companies in the history of the United States. Amazon, Microsoft, Google, those are all laughable compared to the revenue that Fannie Mae and Freddie Mac has generated for the United States. So you'll see it referred to as the offset mortgage. We call it the all-in-one, but that's what it is it's a first lien HELOC. And this is very popular in Australia, Europe, Canada. No one pays their mortgage off. No one takes 30 years to pay their mortgage. No one is on a 30-year amortization schedule. So kind of the way I typically start the conversation is at the end of the month, your household income, your household finances, you're in a place where you're saving at least 10% every month and you're sticking that in a savings account. And if it's more, that's even better. But really, if you're at a minimum putting 10% down in a savings account, then the all-in-one may be a good fit for you. And that's the other thing I'll say is the all-in-one is not for everyone, but everyone should know about it, because maybe today you're not in a position where you could do the all-in-one, but maybe later down the road you should be. I think everybody should work to a point where you've got your finances in a healthy position where you could do the all-in-one mortgage. Because you're going to save thousands and thousands, hundreds of $1,000s potentially in interest because of the way that the product works. So you've got the all-in-one mortgage, the first position HELOC. Mm-hmm. So you are tying that mortgage with a sweep bank account. So basically what's going to happen is all your deposits that you typically were depositing into your checking account to pay your bills out of, and then you are moving that 10% over into a savings account, that is all going to go into the sweep account that's going to instantly pay down your mortgage. So it creates space in that HELOC where you're going to pay all of your bills out of it. And at the end of the month, you're spending just like you were before, but now that 10%, instead of sitting in a savings account, we call those lazy dollars because they're not really earning anything. Now it's working for you to depress and suppress that mortgage balance on a monthly basis. And because of the way that the interest is calculated on a HELOC and the way that it's paid down, ultimately you're going to pay it down faster. I would highly recommend anyone that is interested in this concept of an all-in-one mortgage to go to my website. Just Google my name, Jeff Chisum, Chisum, all-in-one mortgage. There's a savings calculator there. That's where the power is, because that's where you can compare side by side what you have and what the all-in-one mortgage will do. But ultimately, with that kind of design, people are paying that 30-year mortgage off in 4, 5, 6, 7 years. Just depends on what your ability to have extra in that account is. But it is very powerful. And then, you know, you're going to have people that are aggressively paying it off because they want to save as much interest as possible. But that line of credit stays open for 30 years. So you have the ability to use that line of credit for the next 30 years. So you could see how buying a car with your all-in-one mortgage might be to your advantage, because that interest is tax deductible. So there's a tax benefit there. You know, it may be that you pay for the kids' college. It may be that you fund your down payment and closing costs for going and buying on real estate. There's so much flexibility once you get to that point where you've whittled down that mortgage balance. It's no longer this huge liability. It just gives you so much freedom to feel like, oh, I can leverage this equity, go out and do more things. And then it's designed to be able to pay it back quicker. So that's kind of the high level of all-in-one. I get excited about it. It is a bit complex because it isn't normal. It's not well known in the United States. It literally is a foreign concept.
Yeah, it is very popular in Europe and in many European countries. And like you mentioned, the standard fixed rate 15-year 30-year amortization is not. And I'm going to use round numbers here. I know this isn't the true of it because the loan to value is different, but let's say you have, I think some of them that I've talked about, I've looked at, they'll go up to 90% of what your appraised value of your home is. So let's say you have, again, round numbers here. I've got a $500,000 debt on my home. It's capped out, whatever the 85 or 90% of the appraised value is, say $1 million. And I have $250,000 in my savings account. I'm actually only paying interest on the difference between the $500,000 debt and what's sitting in my savings. So I'm only paying interest, simple interest, not compounding, on the $250,000. Then in my case, my main investment is warehouses and storage unit complexes. You're not finding those for under $1 million. So when one of those comes around, if I need 20 to 50% down, I can go, okay, I have my $250,000 sitting in my savings account. I also have a $500,000 line of credit that I can pull out that to the seller, it's cash. I'm writing it like a check. Yep. I'm not having to go to the bank. I'm not having to do anything special. I'm not having to bring in private money. I'm not having to track that down. I have that extra capital available at my fingertips. And it's a massive wealth building tool. And in the case of, I'm a business owner, and when you're a business owner, cash flow is all over the place, right?
Right.
It makes it great because when cash flow is high, and I don't have an asset that I'm trying to buy, I am making more money on my money than it's sitting in a bank account, because I'm not paying interest on the bank loan, right? I'm not paying compounding interest on a bank loan. I'm paying simple interest, possibly at a higher rate, but I'm bringing my actual debt balance down by the money sitting in my savings account. And then, like you said, once I reach that savings account, if I reach a value that's equivalent to what my actual debt is, I can say, hey, I want to pay this off. And now I just have a line of credit to pull from. It's a great tool. I really wish I had set it up earlier for myself. And I have some deals that I was not able to jump on because I didn't have quick access to the capital that I needed. And by having that, it allows me to have that capital. And like I said, the money that was just sitting in my bank account, not earning any interest, well, saved debt interest is still earned interest. It's still earned money, right?
Yeah, no, that's a great point. They also call it the recession-proof mortgage. So if you're in a place where you built that margin between your max line of credit and the actual balance, and you have those months where, there's more down than up, then you only have a required interest only payment, and it's being drawn from the HELOC. So if you don't have the income coming in, you've got your backup sitting in there within the line of credit. So that's nice to have, but just the flexibility of taking advantage of opportunities quickly, because a lot of it is about timing. To be able to move quickly, you don't have to go out and apply for that commercial loan or go out and do that cash out refinance. It is right there, literally at your fingertips, ready for you to pull the trigger. So that's another podcast episode that I would refer people to, like episode 15, I think, creating your own down payment bank. That's basically just leveraging a HELOC against property that you own to give you flexibility and power for when opportunity arises.
Right. And what I will tell people, some people might be thinking when they're listening to this, well, I'll just go pull out a regular HELOC against my home. And right now, HELOCs are running in the 10+%. And with a first lien HELOC, it is variable, but it's prime plus a half, maybe prime plus, I think the highest I've seen is maybe prime plus 2.5. But again, it's calculated as simple interest, and it's a constant running massive line of credit. And then some of them, and I've heard that they'll reassess the property value every 2 years, or if you want a mid reassessment, they'll come in and reassess it at your request. As to where if you're like, hey, no, we had multiple neighbors' homes sold for way more than expected, so can I get a reassessment now? And then that just increases your line of credit without having any additional out of pocket for a new HELOC or anything like that. it is a great tool. It is a fantastic tool.
One of the cool things on the website with that savings calculator, there's some different options on 1 month ARM to 5 month ARM. There's quite a few different options. And the system will take into consideration the historical rate when it's factoring in your cost savings, and it's building the model for you. So that's pretty neat to see, because I think over the past 20 or 30 years, that rate for the most part has been right around 4.5%. It's definitely not anything scary. It's been higher, it's been lower, but for the most part, right around 4.5%. So highly recommend people running through that tool.
And one thing that we're seeing in the commercial market right now is a lot of people that own these businesses, whether they're warehouse complexes, self-storage storage units, laundromats, car washes, they own them outright, and they're willing to sell them with seller financing for way, way better than what the bank is, but they're wanting to see 50% down. Literally just in the last 10 days, I've had 2 self-storage units sent to me. Both of them, they were willing to offer seller financing at 5%, which at 5%, the performance on these, they were going to be cash flowing at a 10 to 12% cap rate, but they wanted 50% down. And if you have just one extra pool or one extra way to grab some extra capital, like with an all-in-one, to make a deal like that happen, one of my mentors tell me, he's like, your life is one commercial deal away from changing, and getting into a right commercial deal, like a solid self-storage unit, warehouse complex, something like that, that you're literally just going to own forever, that's going to cash flow very well from day one. That when you're going to get other loans, when you're going to make other investments, banks look at that and they go, you've got a solid cash flowing asset that's performing well. Yes, we're going to loan you again. And banks want to get behind winners, right?
Yeah.
Banks don't want to get behind people that are making bad investments and hoping that they'll turn into something 10 years from now. They want the ones that are performing now, that are winning now. And that really changes your whole trajectory of your investment line. So
absolutely.
Really cool. Sir, I want to respect your time. I told you I'd cap this at an hour, and we're right at an hour too. So amazing information you provided to us. I really appreciate you taking the time. And this is information I'll disseminate to all of our listeners and many others. You are in the DFW area. I'm there almost every month. So love to come by, and I think I owe you a steak dinner for you taking the time to do this. I think we can get steaks in Dallas, right?
Oh yeah, there's some good beef around, I think. Yeah, absolutely. Yeah, would love to break bread. Absolutely.
Yeah. Wonderful. Well, thank you again for your time, sir. And that's all for us today at the Build Better Homes podcast. Thank you for listening. Jeff, please give them the contact information for anybody that may want to reach out to you.
Yeah, the best way to connect with me is through my website, strhomefinancing.com. So we put together some really good informational videos there. They're short, sweet, to the point. And then there's an opportunity to schedule a phone call, discuss what you're looking to do, and then talk about next steps. But yeah, good information on that website. There's a chat feature if you want to send us a quick note, but absolutely the best way to connect. Appreciate that.
Wonderful. Yeah, your website's very helpful, and your staff has been very responsive and fantastic anytime I've ever had a question for them on anything. So really,
it's all about the team.
It is. Hey, sir, thank you again for your time, and have a wonderful evening.
Appreciate it, Roy.